Hello, I'm Simon Turner, Head of Content at Investment Markets, and welcome to today's debate, which is entitled, Will the S&P 500 continue its historic bull run during the remainder of Trump's second presidency? When we were initially planning this debate a couple of months ago, the US market appeared unstoppable after a multi-year bull run of epic proportions. For most global investors, it was the main investment game in town. That world feels like a distant memory right now. Trump's second presidency has already surprised most investors for all the wrong reasons. He's breaking laws, introducing tariffs, circumventing Congress, and encouraging Elon Musk to dismantle government departments. Most legal scholars agree the US is in the midst of a constitutional crisis. So the question is this all noise, or have we entered a different phase for the S&P 500? Needless to say, this debate has become a whole lot more interesting in recent weeks and a whole lot more relevant for investors. With that said, it's time to introduce our expert speakers today. Representing the US bears of the world will be Sam Chipkin, the Chief Investment Officer and founder of 5AM Capital, a fund manager focused on investing in high-quality global equities, preferably with monopolistic characteristics. Sam lived in New York for many of his 20 years of investing experience, so he has a lot of on-the-ground US perspective to add to this. And representing the US bulls of the world will be George Clapham, a founding partner of 8 Bays Investments, a specialist investment ETF investment company aimed at generating superior returns with low volatility. Both our speakers have extensive experience of successfully investing in US and global equities. So the ground rules for today's debate. Each speaker will have up to 10 minutes to address the question about the direction of the US market for the rest of Trump's presidency. Then each speaker has up to 5 minutes to rebut the other's argument if they so choose to, except on they can rebut anything except in relation to the other's fund performance and strategy. And finally, if we have time at the end, we'll conclude with a few questions aimed at delving deeper into this fascinating subject. Also, just to highlight, we're calling this a debate, but it's not a traditional debate in the sense that there'll be a winner awarded at the end. The idea is to open up a very interesting subject to help equip investors with all they need to know about it. So with that introduction out of the way, let's start the debate. Sam will be kicking things off with his bearish view of the US market. Over to you, Sam.
Terrific. Thank you, Simon, George, and hello, everyone. I'm Sam Chipkin, founder and CIO of 5AM Capital, and it's a pleasure to be here for what I'm sure will be a thought-provoking and timely discussion. Today, I want to make the case not for panic, but for caution when it comes to US equities during Trump's second term. We're not forecasting a crash, we're not Jimmy Chanos, and we're certainly not saying that US equities should be avoided altogether. Our fund still holds US exposure, and we continue to find a small number of exceptional US businesses that meet our quality and valuation standards. But given today's elevated valuations, policy risks, and the global opportunity set, we believe a more balanced, more selective approach is warranted. Before diving into the substance, a quick word on the context of our approach to assessment of value. 5AM Capital is a Sydney-based global equity fund manager that I launched in 2022. As Simon said, I've spent 20 years investing globally, including with Macquarie and as CIO for a family office, delivering 30% annual listed returns. We manage a single strategy, owning 15 to 30 high-quality monopolistic businesses with strong balance sheets, high margins, and durable cash flows. Since inception, our fund has delivered 18% annual returns, and we invest alongside our clients. So when we talk about markets, we do so with real capital at work. And it's from that perspective that our view on US equities is measured but clear. We're really cautious. Many US companies face slowing demand, rising costs, and political uncertainty, yet trade at historically rich valuations. In this discussion, the 4 key points I'll cover are 1, US valuations, a pricing imperfection. 2, Trump 2.0 brings renewed geopolitical and policy risk. 3, the passive investing adds to market fragility. And 4, importantly, there are some great opportunities outside the US. So firstly, US valuations. We're underweight US equities, not because we doubt American innovation, but because we doubt perfection. The S&P 500 cyclically adjusted PE of 33 times is nearly 80% above its long-term average. The Buffett indicator, market cap to GDP, is above 180%, near record highs and double the levels from prior decades. Valuations don't predict timing, but they do shape outcomes. When prices assume perfection, the risk-reward skews negatively. US stocks trading at 22 times forward earnings on average, which is in their top decile of historical norms. That compares to 14 times in Europe, 11 times in the UK, 13 times in Asia. Investors are paying a real premium for US exposure, and in our view, they're not getting enough return. But we don't just look at PE and make a decision, far from it. We do deep fundamental analysis, focused on cash flows, margins, durable and sustainable competitive advantages. And there are some moderate to high PE stocks in the US that are appropriately valued. But the US market as a whole, that's where we're cautious of the risk-adjusted return. So the second point, and key to this discussion, Trump 2.0, the geopolitical wildcard. Politics and investing don't always mix, but policy risk is real, and investors ignore it at their peril. Trump's return introduces volatility. We saw it during his first term, tweets turned into tariffs, regulation by surprise. And this year, as Simon mentioned, over $4 trillion in market cap wiped out in the weeks following new tariff proposals. Why? Because uncertainty freezes business decisions. CEOs pause hiring, supply chains get disrupted, costs go up, margins compress. And it doesn't stop at trade. We're looking at potential tax changes, antitrust investigations, challenges to the Fed's independence, the debt ceiling brinkmanship. All of this raises the premium on US assets. It's not about politics, it's about probability. Trump 2.0 adds noise, raises risk premium, and further tilts the case for global diversification. Unlike Trump, we're not about flashy headlines. We're about honest relationships that stand the test of time, cutting through the noise and weathering cycles. The third point is a nuanced one that I wanted to discuss. That passive investing has created a flywheel that magnifies market fragility. 1/3 of the US S&P 500 market cap sits in 7 stocks, and every dollar into an index fund gets funneled into the same names on autopilot. And this creates a flywheel. Fund flows push up pricing, driving and drawing more flows. But when sentiment turns, the same mechanism can unwind quickly. When price action is driven by flows and not fundamentals, you're not investing, you're chasing momentum dressed up as diversification. As active managers, we don't want to play that game. We can sidestep the crowded corners of the market. So let me give you a few examples of the 490 companies in the S&P 500 that we're actively avoiding. I'll start with Tesla, a topical one. Now, I admit it, I like the product, but the stock trades at 125 times earnings. To justify that, you need to believe that Tesla will utterly dominate global autos and energy with huge margins. That could happen, but the margin for error is near zero. And even with Chinese EVs kept out by Trump tariffs, we're not comfortable with the valuation or the Elon governance. US regional banks, we still see them as fragile, opaque, and exposed to rate risk. Many sit on unrealized bond losses. SVB and the First Republic Bank are reminders of how quickly these bank balance sheets can dissolve. In the US, there's a lot of low-quality retailers, industrials, and cyclicals. They have no pricing power, high debt, exposed to economic swings. They're statistically cheap, but fundamentally weak. We don't see these as opportunities. We see them as value traps, and there's little that Trump policy can do to salvage these businesses. Now, the good news is that outside the US, we're finding real value. International markets are significantly cheaper. Europe trades at 14 times earnings, the UK at 11, Asia Pac at 13. Many of these markets sit near historically low valuations, and more importantly, we're finding great businesses behind those numbers. Let me give you a few that we hold or favour. Eurofins Scientific in France, a global leader in lab testing for food, pharma and environment. Essential demand, strong margins and trading at just 7 times EV. Mnet, the REA of Sweden, with a 90% share of online property listings and a lot of pricing strategies in their arsenal. Enterprise software names in Amsterdam and Germany, with recurring revenue, capital light trading at T multiples. CK Hutchison in Hong Kong, a diversified ports and telecom conglomerate trading at 6-time earnings and well below sum of parts. And Japan, which is finally undergoing a shareholder revolution. But TSE is pressuring companies to unlock value, leading to buybacks, restructuring, and a real shift in governance. There are some great businesses in Japan, infrastructure, software, and the actual stock exchanges of business. These have in common, they dominate their industries, they generate durable, often contractual revenue, they have strong balance sheets, and they trade at prices that leave room for upside, not just hope. So in conclusion, where does that leave us? The US remains home to some extraordinary businesses, but the S&P 500 is not a free lunch. It's expensive, it's concentrated, and it's increasingly vulnerable to policy risk and passive momentum. We believe it's time to rebalance, not abandon the US, but to supplement it with non-US businesses that are less crowded, less euphoric, and more reasonably priced. The US is over 2/3 of global market cap, and our fund is circa 50%. As Howard Mark puts it, you can't predict, but you can prepare. And at 5M Capital, that's what we're doing. Up early, staying disciplined, hunting globally, and positioning for what comes next. Thank you, Simon. Over to you, George.
Thank you for that, Sam. Yeah, so they were all great points. George, do you want to carry on with a more optimistic view of the US market?
Okay, just a little bit of advice for some younger people out there, perhaps, that if you put a little bit away in the S&P 500 over the last 10, 20, 15 years, you would have outperformed the Australian stock market by about double. So roughly 12% CAGR since inception. You buy one ETF, put a little bit away each month in the top 500 companies of the world, and you've delivered a sustainably positive return. Now, the first ETF came out of the US, the SPDR, and that was just after the 87 crash. And since then, the US market, which is the most innovative in the world, is now something like $11 trillion in exchange-traded funds. Now, just to put the exchange-traded funds market into perspective, it also dominates roughly about a third or fourth, 40% of turnover in the US market. We set up 8 bays, 2019, 2020, with the single strategy of focusing on US industry ETFs. Not thematic, but industry ETFs, because we are industry pickers and sector selectors. We have a very transparent portfolio. And since we launched that fund, our strategy, we've done 19.6% per annum with a low standard deviation, only about 1% or 2% above the market. Believe it or not, we have 906 stocks in our portfolio through this strategy. We're the only strategy that does this, and we're currently running, I think, 8th in the Mercer survey over 1 year and 12th over 2 years, and I think top quartile over 3 years since we've entered that survey. Now, what we like about, and currently, I'll just give us our position. So we have about 9 industry ETFs in our portfolio, and we also run a couple of stocks which enhance our industry positions. And we're trying to focus on well-structured industries with pricing power, and that tends to lead you to a lot of US companies. I'll take, for example, cybersecurity. essentially the cybersecurity industry is dominated by US Silicon Valley players. So Palo Altos, these sorts of guys, CrowdStrike, etc. So if you take the US tech sector, which is roughly about a quarter of our benchmark, which is the MSCI, the US tech sector generates 56% of their revenues outside of the US. So it's we are industry pickers, not country pickers, but currently our portfolio, we're about 87% exposed to US stocks, and I think the MSCI is about 65 or something. So we are essentially overweight US, but that's on a bottom-up basis, looking at the industries that we're focusing on. Now, if I take what's happened in the last month or two since Trump came in, there was a lot of signaling before Trump came to power about tariffs, about energy, and you had to sort of do a little bit of positioning around those sectors, particularly in ETF land, to say, well, what's going to get hit and what's going to get... No one predicted such turmoil in terms of the delivery of this tariff policy. But Trump, in some ways, is playing a long game. And the long game is that they have a debt problem in the US. And I think, Sam, you agree with me here that you cannot keep growing debt the way they have been under the Biden period. And so he has to look at the US balance sheet and stop the growth in debt. And so his strategy is to effectively tax the rest of the world through tariffs, because the US is the largest consumer market in the world, something like a $30 trillion market, in order to keep income tax low. So effectively, it's like a giant VAT on the rest of the world to raise revenues. At the same time, he has Doge under Elon Musk attacking the cost base of the federal government. And Doge has obviously come out with some incredible opportunities in terms of cost savings through Washington. So the longer game is actually trying to set the US on a better course in terms of their balance sheet and the debt crisis that we could be facing. So this is going to cause short-term repercussions, which we're seeing. Now, what is the impact of that? Obviously, we've seen a major correction in the US equity market from probably an overvalued point of view, and I agree with you, Sam, that US, particularly the upper end of town, all the Magnificent Seven, as they go, we're all trading very expensive. But if you look beneath those stocks, the Russell 2000 is not that expensive relative. So that there's been a stretched valuation between large cap growth and the rest of the market. So there's still a good chance within the US market that there's good value in the small to mid caps, and we actually have a bias towards small and mid cap stocks, because within an ETF you get a vertical which tends to give you not only the best in the industry, you can get the worst in the industry, but you also get the industry risers. And the US market typically does reward companies for success. And if you take a company like NVIDIA, which has gone up 3,000%, a stock that we've held, their earnings have gone up 3,100%. So the PE's actually come down. This is the cheapest NVIDIA's ever been, so it's sort of down in the low 20s now. But at the same time, if you own an industry ETF, the semiconductor space, Intel was a loser, NVIDIA was the winner, but overall, NVIDIA, Taiwan Semiconductor make that industry bigger. So in a sense, what we're after is, if we're looking at semiconductors, which we're currently overweight, is that industry going to be bigger in 5 years' time? And we think, yes, it will be. Now, the question is, do these events change the outlook for that industry? Do they affect the CapEx plans of Amazon, Meta, Google in terms of AI. And I think, and Sam, you'd probably agree that the balance sheets of a lot of these US companies are pristine. They have cash coming out of their wazoo at the moment. So, and you might have noticed that your Microsoft subscription costs went up the other day. And if you paid for Copilot, you're paying for this and you're paying for that. And do people chuck out their Microsoft subscription because it went up a bit, or do they turn off their Google, whatever? I mean, I'm using an AI service called Perplexity. And since I started using Perplexity, which is backed by Jensen Huang and Jeff Bezos, etc., that service has now gone from $300 a year to $60 US a month. So there's still demand for those services, and we like those industries. So I'm probably moving around a bit, but if I look at the US market, I think that this could be a significant opportunity, but I would caution two things. I think the market is probably saying now we're facing potentially a recession. Now, why is there going to be a recession? I think confidence, one, has been hit. Business investment is going to be hit because no one has any idea what to do with their factories in China or Vietnam or anywhere in the world for that matter. So there's the investment flows could halt. And thirdly, margins of businesses could be affected by these tariffs, and we don't know what the margin impact's going to be. So if we're looking at the S&P earnings growth, which was, I think from yesterday, FactSet was running at 10 or 11%, there's definitely going to be downgrades. But to some degree, the market's reacted to that already. So chance of a mild recession, then we've got to say, well, what industries are we going to be in? Chances of a severe recession, what industries get hurt the worst? So just a quick snapshot is, if we're looking at mild recession, we think that the worst sectors to be in still are consumer discretionary, things like travel, luxury goods, automotive, those sorts of sectors, the discretionary spend. To a large degree, they've been hit. I mean, you've seen that US airlines falling 30 or 40% just in the last month or so. The sectors which will sort of probably coast along, but not, might do well, are still the consumer staples, which, there's some very attractive consumer staple stocks, and they tend to get bid up. Maybe financials, because financials, unless the balance sheet, if this BDDs drive up significantly, but they'll get hit by less deals, for example. JP Morgan had a fantastic result on Friday, but ultimately it's going forward in a mild recession, financials should coast through. If it's a severe recession, then all bets are off. Financials do get hit. They're a very cyclical sector, and that would hit the Australian banks as well. But the better sectors, I think, are those ones, probably stocks that you focus on as well, Sam. Resilient, strong competitive advantages, immense pricing power, and they tend to be in software, infrastructure, broad healthcare, and healthcare is actually cheap, but there is some political risk around healthcare. But by and large, the healthcare sector has been discounted. The market's probably pricing, say, a mild recession, which is the 2 quarters of negative growth, and S&P 500 earnings, which I must say, if you look at the earnings of the S&P 500, that has really driven the performance over the last 10 or 15 years. Particularly, large cap growth stocks have been growing their top line in particular, and being short those large cap growth stocks hasn't been good for any investment manager. But ultimately, it has driven earnings growth, in almost the 10% region. Now, this year, the earnings growth of the S&P was forecast around 10 or 11%. and that rate's coming down according to FactSet. So if we see a mild recession, we're probably going to see flat to zero growth, something like that. A severe recession, because of the structure of the US market, a lot of these companies are fairly acyclical, but some of the media, the social media, the Googles, whatever, will be impacted in terms of advertising, etc. So we'd probably see another 15% plus earnings downgrade. So ultimately, that means, again, you'll have to be parked in areas such as, I still think software, utilities and healthcare should do better. There are some sectors of the market, industries though, which might grow beyond what's happening to the consumer. And I'm thinking now, cloud services, for example, companies like Microsoft and Amazon and Google Cloud Services, they seem to be ultimately, are you going to turn your Netflix off if you haven't got a job? I remember seeing the last recession, the first recession I went through, which was, I just sort of moved to London. I left Australia and I started doing emerging markets for BT back in the late 80s, early 90s. And, there was quite a severe recession, obviously, in Australia. And then we had things like Tiananmen Square. So we had Gulf Wars and stuff. But I did notice that people kept watching soccer on their Sky satellite, and going out and seeing Sky at that stage was losing lots of money, but it survived and became obviously a very strong media platform. So the cloud services drives all of that streaming industry, so they might sort of survive a bit better. So that's the sort of way we sort of think about markets globally. We're looking at industries which we think might do better. Another little example in terms of how we sort of strategize things here is we think energy is a really interesting space. Not so much renewable, but the energy transition story, which is a multi-trillion-dollar industry, and also the fact that obviously GPU-based AI centers are churning up a lot of energy, and there's a constraint at the moment. So they'll have to have more gigawatts of power to support this growth. So energy transition is interesting. We think one of the sectors that's going to do well will probably be gas, because it's the quickest, the fastest way to ramp up energy capacity. And we're playing that. We've got roughly about 10% of the fund in the US pipeline industry, and that's about a dozen stocks there just in that one vertical. And so we see growth in LNG, growth in the pipeline sector, and consolidation as well as something which we see is happening in that sector, because there's about a dozen pipelines. So these are sort of things you've got to look through when you have these crises. But obviously these crises present broad opportunities, and but just be wary of the industries and the sectors that you're plunging into, and look at the ones that are going to structurally improve. So that's why we're still relatively bullish on the US market. We see the US market as possessing a bunch of stocks which are industry leaders. We don't specifically go out and target, if we're looking at the best player in whatever industry it is, it could be, in Holland, they've got ASML, which is, provides the machines that go into the fab plants, and pretty much monopoly. If that industry is there, we're going for that stock there. So we're sort of, I would say, totally country agnostic, but ultimately at the end of the day, there's a hell of a lot of strong leading companies in the US market.
Thank you for that, George. You made some great points there. Sam, would you like to rebut any of George's arguments?
Look, George made some terrific points, and I think, as he alluded to, that there are some aspects that we really see and are quite aligned on. The structure of our fund, we focus on monopolies. We've got 4 key segments of those monopolies. One is infrastructure, and George mentioned, the resilience that infrastructure can show, pipelines, etc., can show during a recessionary downturn. It's also protect capital in stable expansionary dynamics as well. We like enterprise software, where it's providing significant value to the end customer. They're not going to churn in a downturn. They've got pricing power. And George mentioned Microsoft, which is an incredible company. And there are other fantastic enterprise software companies that add a lot of value to the customer, and people aren't going to churn. So they're fabulous. Online classifieds we like. There's some natural monopoly dynamics at play, where the leadership position has so many eyeballs, and so if you're a REA type of business or elsewhere, you want to back those leading businesses. Some of them are in the US, some of them are external to the US. And we like healthcare as well, provided it's the right dynamic. If it's got a testing and commissioning overlay, that's particularly attractive. We think some of the US healthcare businesses are still priced too expensive, and there's a lot of dynamic taking place with healthcare in the US, and will be over the next 4 years. And so we do like some of the European healthcare names by comparison. There was a discussion of Doge, where by Musk is rightfully targeting some inefficiency within government spending. And we think that's really suitable and important. It needs to be done in the US. I think it needs to be done in a lot of other countries as well. Governments can't just keep on campaigning on greater spending. There also needs to be efficiency and assessment of cost-benefit analysis. But where he's focusing with Doge, the costs that have been mentioned to date that he's saving, it's more around the periphery, because there's so much tied up in the core operation of the US. But we do want to see him succeed. I think something that George also mentioned is really interesting. The US is an incredible economy. It is resilient, and it has the best set of consumers in the world. and that's a really interesting dynamic. I mean, it used to be the manufacturing center, but now actually the advantage of the US is their huge middle class consumer base. And I think, there's real strength in this purchasing power of the consumer base. And Trump recognizes that. That's why he's trying to, charge non-US businesses for the privilege of trying to access and sell to that US base. And he's seeing that as a way to raise revenue for the government while keeping taxes low. That in itself, it's an interesting dynamic. But we don't really have an interest in luxury goods or discretionary items anyway in expansionary times, and definitely not in this sort of a dynamic. And then thinking more broadly about the US, the point that we were raising is that, yes, it's a great country. Yes, there's going to be continued innovation there, but there's a lot of strength attributable to the US already priced in. And so valuation to us matters hugely. You're paying a premium for US growth, and that can hurt your returns if it doesn't fully accelerate over the next 4 years. And we're cautious of that. We're not calling a major recession, but we're cautious of continued very, very strong growth. So from our perspective, we're underweight the most expensive US mega cap stocks, and that entails some concentration risk. But it's not about abandoning the US. It's about right sizing to reflect today's realities, and our clients to participate in the strength of the US economy and the rest of the world, aiming for sort of robust returns with lower risk. We're not saying go all into the ASX. So I think George mentioned, that the international returns have been far stronger than the ASX week, and we think that will continue. The ASX is only 3% of total global market caps. Don't make that 67% of your portfolio and flip it with the US. That would be, I think, a disaster. Our track record shows that we're disciplined, and global in our strategy, and that can deliver our performance. And we really believe that the coming years will reward those who look beyond the US, but are very careful and strategic in how they're investing.
Thanks for that, Sam. George, any final words from you?
Yeah, just I agree with Sam on the large cap growth sector, which we're actually underweight as well. But one of the things that I think is a really important place to be focusing your attention is US Treasuries. And we had a funny week last week where US Treasuries sold off and US equities rebounded, sort of a bit of an anomaly there. I noticed they came back, but the whole focus of the US is trying to fund their debt mountain, and this is the same thing in Australia. I mean, we've just pushed through $1 trillion of debt, and we're funding it at probably 2 or 3%. We're going to roll off those sorts of bonds and onto about 4 or 5%. So, that's a big expense to the budget bottom line, and we're going to see that in the US when they're spending something like almost $1 trillion on debt servicing, and I think this is what is missing a little bit in this debate about the US, but it also goes around the rest of the world because they've got similar issues with the sort of debt service growth that's going to happen. Trump and Besant, Ludnick, these guys, remember that they're actually trying to address this problem. They've got to level off the growth in government debt and level off the growth in government debt servicing. So that in itself would help with the supply of treasuries, obviously. So that's a plus. So you've got to keep treasuries, hopefully below 4%. But ultimately, going to your point, Sam, that you might have a high equity risk premium going forward, so further multiple compression for the US market. So that might occur. Inflation is the other thing we haven't really talked about. I'd just like to end on that. Essentially, the tariff should be ultimately a one-off hit, like introducing a GST that everyone cops and we move on. It's not, inflation is about, is there going to be structural inflation going forward? Now, to some degree, we got the structural benefit of China coming into the WTO and dumping cheap goods on the market. So those days might be over. So again, we're going to have a little bit more inflation, which again would put up the equity risk premium and drive the multiples lower. But ultimately, I think it's short-term pain because he's got to do this before the midterms in 15 months' time or something, because he'll probably potentially lose control of the Senate or something. So with that, I think hang in there, as they say.
Good points, excellent points. So one of the observations I had from watching you guys both talk was that you agreed on a lot of points. You both agree that the US market is relatively expensive at the moment. You both agree geopolitical risk is quite high at the moment. Economic risk is pretty high. One of the main differences I noticed in your perspective was around government debt. That's obviously a big part of the US investment case at the moment. So George, you seemed a bit more optimistic about how the Make America Great Again policies will impact upon US government debt levels. Whereas Sam, if I got the message right, you seemed a bit more cautious on that. Sam, mate, do you want to maybe delve into that? Do you think that US government debt levels can be brought under control now? Or do you think this is a risk that will keep sort of building from here?
I think it's going to be a moderately persistent but manageable risk. I think the US, as the strongest and largest economy in the world, benefits from being able to almost expand its balance sheet perhaps more than others. But it can get to a point where it just becomes way too difficult to service. And you do need to start bringing back spending and finding ways to reduce your large debt burden. Bringing down the interest rate helps because then the debt payments are obviously less. And so there are maybe some gains. And I think, Trump sees himself as a bit of a, bit of a negotiator, bit of a gambler, wants, might try and achieve an outcome by doing something else that's a bit unexpected. And so, he sort of sees himself as part of the art of the deal, but we're cautious of what that brings. The other side is that I think most government debt levels are really high globally. So, this is a little bit of a discussion around, where's the best markets to invest in. And, there are a lot of issues in Europe and in the UK and parts of Asia as well, Australia as well, where we've seen, what was a surplus turning into a deficit and reasonably high. And, there are large aging population concerns that are going to increase spending over the longer term. And politics keeps on campaigning on more spending. So, I think the world as a whole has a big challenge in actually, bringing this under control. If the governments themselves were businesses and we had choices to, invest in them, I wouldn't want to, right? We like cash flow generative businesses that are profitable, have high margins, and durable. Now the governments are durable, but they're not profitable. They don't have high margins. They're really all spending more than they're bringing in, and so it's just all of them have a challenge in navigating that appropriately, and they don't want to see their governments collapse. There was huge amounts of stimulus in COVID, and we haven't seen that repaid.
I agree, and I think I was listening to just the other day, but ultimately for the US, you can't be running a deficit of something like 7% of GDP when your economy is growing. That's something you do when you're having a recession. And I think their ultimate target is to get to 3%, which all governments need together. They should be sort of mandated to get towards 3% as a sustainable deficit to GDP ratio. They're going to work on it very quickly, and that's, if it gets there, I think that'll be quite good for bond markets per se, which obviously a lot of risk is priced off. So, my view is that they might lead the way in this. Admittedly, the US is trying to outsource a bit more of their defence spending to the rest of the world. So, Germany's, going to throw money at defence like double the amount of expenditure on GDP. So that this will actually create opportunities, obviously, in X markets. But I think for the US at the moment, it's going to be tough. It's going to be tough for a little while until we get some resolution. But remember that there's an end game, and it is around solving this debt crisis, which is the elephant in the room.
And I agree with that, George. And the point that I'd raise then is, part of investing is what you're not investing in. We're very specific about what we don't invest in the listed markets, but we're also really cautious around people who have too much exposure to bonds. As an example, I think the returns have been anemic for a lot of bonds over a long period of time, and the sort of wildcard risks at the moment don't start to position that in a better risk-adjusted return. There's been a lot in sort of these grey private credit market dynamics, so there hasn't been a lot of regulation around how lending standards are adhered to and how risk measures are reported and losses are verified. And in a recessionary pullback, and there's a big private credit dynamic in the US as well as in Australia, some of that can really start to get unstuck. So we remain steadfast that having investments in high quality, durable equities is a fabulous way to achieve long-term compounded returns.
Which is really important for investors out there, is equity markets globally are liquid. Private credit markets aren't.
Yeah.
We saw this, the one thing I learned in the GFC was liquidity when you had counterparty risk, and we were trading a $7 billion fund, and suddenly we couldn't trade with Bank of America. We couldn't sell stock, we couldn't buy through that, and we ended up, liquidity is, and then they started freezing funds. A lot of these sort of, so I think for those people listening, it's in times of crisis, these markets do offer liquidity, large, listed markets, and that's important. If for some reason you need to access emergency funds, you can sell, you can buy, and that makes it a hell of a lot more attractive. So I think that there might be a clean out in that space. I agree, Sam, potentially.
Absolutely, George. Liquidity matters because it also shows transparency in pricing, which is sometimes hidden in some of the unlisted markets. And so I think it will be so sometimes investors are their own worst enemies in terms of the actions that they take in bull and bear market dynamics. And I think it would be unfortunate if people start to rotate out of some high quality great equities into some asset classes that they think are going to provide them protection, but don't actually end up providing them protection.
Yeah. And we find that in ETF markets, because we're trading ETFs. We only trade in the US market because of the biggest, most liquid market. We don't trade US Australian listed ETFs, and it's got a rich sort of data. But even during the COVID crisis, liquidity was fantastic. With the spread over NAV was tiny. You could get out, you could get in. Even in some of the debt-based ETFs, they all work very well. So it's important to make sure that you're invested in funds that have invested in the right markets.
Just to conclude the chat, George, you mentioned inflation, which has obviously been a huge theme for investors for a while now. I was reading some research the other day showing that US equities were one of the best ways to protect yourself against inflation, and looking back like 40, 50 years. Do you think that will be a big part of this looking forward? Do you think inflation will feed into US equities? And do you think it will be a case of investors sort of being forced to invest in asset classes like this because inflation is a longer term risk?
Well, I think in terms of inflation, it's earnings, and what companies benefit from slightly inflationary periods, and we had those inflationary periods, post-COVID, and they tended to be some of the consumer goods, stable stocks could pass on price increases. So your Procter and Gamble's and those sorts of, they seem to have some pricing power, but again, it depends on those sectors that have got pricing power. But ultimately, I think because of the makeup of the US market, it's got a number of large companies that have the ability to price increases through. So, I mentioned earlier, like Microsoft can bump up their 365 numbers of those sorts of things because there's relatively no competition, So yes, maybe the US does better in a slightly inflationary period.
And Sam, how is inflation feeding into the way you're allocating capital at the moment? Do you see it as a longer term theme?
Look, we believe that equities, and as you said, statistically, this is proved out over the long term, equities are the best way to protect against inflation, because inflation erodes your dollar holdings, and if your equities aren't growing, with or at above inflation rates, you're actually going that backwards in real terms. So That's important, and we look for businesses that have strong pricing power, so they are able to feed through pricing increases, and in fact, inflation can actually, almost provide them levers to increase their margins, because they, if you're a high margin business and you increase your top line by say 4% to adjust for inflation, you actually get much more than that on the NOI margin. If you're operating at 50% NOI margins, you'll get a derivative of that, a multiple of that down below, which is a fantastic outcome. But I also do somewhat believe with George on his point before about the inflation dynamic in the US, and that's why I didn't want it to be a leg for part of this debate, which is that all these tariffs, yes, inflationary, but they're sort of a one-off hit. And once things get rebalanced, it's sort of, yes, it becomes more expensive, but it doesn't mean that it's going to keep growing at a much higher rate thereafter. It sort of gets rebalanced and then goes back to the normal trend line. So, we don't think inflation is going to necessarily be a huge headline on an ongoing basis in 3 years' time. But we also aren't constructing portfolios based on macroeconomic predictions. As it's been said multiple times, the Fed and all these groups have huge teams to try and understand rates and inflation metrics, and they often get it well wrong. So we don't feel like we're better placed than them, and we just want to invest in good companies that can weather and eat the dynamics.
Just another point on inflation. Now, we don't know where AI is leading to, AI and robotics, but ultimately this is a significant change in our lives. At the moment, we are using AI, and it's bringing down the cost of services. It will bring down the cost of goods made through AI-based robots, etc., etc. So there's another phase, I think, where productivity, the productivity benefit from the rollout of AI, you're probably seeing it within some of your companies when they speak to what benefits they're getting in terms of, savings. And legal services, for example, I'm now using an AI agent to provide me with some very good legal advice, which would cost me a hell of a lot, looking at property services, these sorts of things. So there's potential for real disintermediation, structural change from the introduction of AI into all sorts of industries. So essentially another deflationary force which is coming now.
Guys, I think we're out of time, but I just want to say thank you both for a fantastic discussion. Really, really interesting points raised by both of you. And I think investors will really benefit from listening to what you've said today. So if you're listening and you'd like to learn more about 5am Capital or 8Bay's investments, you can obviously go to their websites and also investmentmarkets.com.au for more information. So I just want to say, Sam and George, thank you very much. It's been a pleasure.
Thank you, Simon. Thank you, George. It's been a pleasure.
Nice to meet you, Sam. Simon, thank you. And thank everyone else for putting this on.
Thank you very much.